Most investors lose, not because they made bad picks, not because they timed the market wrong. They lose because they never understood what they were trying to build in the first place. Today, we're going to fix that. We're going to break down exactly how index funds work, what the real compounding math looks like over time, and the 3 quiet mistakes that cost the average investor years, sometimes decades, of growth. Let's start with a question most people can't answer. What is an index fund actually? Not the textbook definition. What it actually does to your money. An index fund is a basket. It holds a piece of hundreds, sometimes thousands, of companies at once. When you buy a single share of a broad market index fund, you are not betting on one company. You are buying a small ownership stake in the entire economy. When the economy grows, and over time it always has, your investment grows with it. That's the foundational principle. You are not trying to be smarter than the market. You are simply owning the market. This matters more than most people realize. Here's why. The average actively managed fund, meaning a fund where professionals try to pick the best stocks and beat the market, underperforms a simple index fund in roughly 85 to 90% of cases over a 15-year period. Not most of the time. Almost all of the time. These are professionals, with research teams, data systems, and decades of experience. And they still lose to a fund that simply holds everything and does nothing. That is not a small detail. That is the entire argument for index investing. Now let's talk about the math, because this is where most people are missing the picture completely. Let's say you invest $500 per month into a broad market index fund. You do this consistently for 30 years. You contribute a total of $180,000 of your own money. At a historical average annual return of roughly 8%, which is conservative by most long-term market standards, your account does not grow to $300,000. It does not grow to $400,000. After 30 years, that $180,000 you put in grows to approximately $745,000. That gap, the difference between what you put in and what you end up with, is compounding. And it does not behave the way most people expect. In the first 10 years, the growth feels slow. Your $60,000 contributed has grown to roughly $87,000. Meaningful, but not dramatic. In the second 10 years, it starts to shift. Your account crosses $200,000, then $300,000. But the third decade is where everything changes. In years 20 through 30, your account adds more value than it did in the first 20 years combined. This is why time is the most important variable in this equation. Not the amount you invest, not the exact fund you choose, not your income level. Time. And this is also why starting late is so costly. If you start at 25 and stop contributing at 55, that same $500 per month produces around $745,000. If you start at 35 and stop at 65, same amount of time, same contributions, your result is similar on paper, but you've permanently lost the years where compounding was doing its heaviest lifting. Starting 10 years later is not a minor setback. In compounding terms, it can cost you hundreds of thousands of dollars. Now let's talk about the 3 mistakes that quietly destroy index fund returns. Mistake number 1, selling during downturns. Every few years, the market drops. Sometimes 10%, sometimes 30%, occasionally more. When it happens, people panic. They sell. They move to cash. They wait for things to stabilize. And in doing so, they lock in their losses, miss the recovery, and permanently damage their long-term returns. Here's what the data shows. If you invested $10,000 in the S&P 500 in 1993 and left it completely untouched for 30 years, you would have ended up with roughly $210,000. If during that same period you missed only the 10 best trading days, 10 days out of more than 7,500, your result drops to around $96,000. 10 days. Half the result. The best days in the market almost always follow the worst days. The people who sell during crashes almost never buy back in before the recovery begins. Staying invested is not passive. It is one of the most disciplined financial decisions you can make. Mistake number 2, chasing performance. Every year, one fund, one sector, one asset class posts extraordinary returns. And every year, money floods into it. The technology sector explodes. Everyone buys tech funds. Emerging markets surge. Everyone rotates into emerging markets. This behavior is documented and consistent. Investors pour money into what performed well last year, right before it regresses. And they pull money from what underperformed last year, right before it recovers. A broad market index fund eliminates this trap. You are not betting on last year's winner. You are holding everything. When one sector underperforms, others compensate. Over time, the whole market moves upward. Chasing performance is one of the single largest destroyers of individual investor returns. The simplest protection against it is owning all of it. Mistake number 3, fees. This one is invisible, which is exactly why it's dangerous. A fund with a 1% annual expense ratio may not sound significant. But over 30 years on a $200,000 portfolio, a 1% fee costs you approximately $140,000 in lost growth. Not in fees, you see. In compounding, you never get. Broad index funds from major providers commonly charge between 0.03 and 0.20% annually. The gap between 0.05% and 1% compounds silently against you for decades. Low cost is not a minor perk of index investing. It is a core part of why it outperforms. So let's bring this together. What should you actually do? Step 1. Open an account if you haven't. A standard brokerage account or a tax-advantaged account like a Roth IRA or 401k. Step 2. Choose a broad market index fund with low expense ratio. The specific ticker matters less than the structure. Broad exposure. Low cost. Simple. Step 3. Automate a monthly contribution. Remove the decision from your routine. The money moves on its own. You don't watch. You don't react. You don't adjust. Step 4. Do not touch it. That last step sounds easy. It is not. You will watch it drop. You will feel the urge to act. The discipline to do nothing during a market decline is worth more than any stock pick you will ever make. Index funds do not build wealth because they are exciting. They build wealth because they are boring, consistent, and ruthlessly patient. The math rewards the person who starts early, contributes regularly, keeps costs low, and does not interfere. Not the loudest investor, not the most active trader, not the one watching charts every morning, the one who planted the tree, walked away, and let it grow. That is how index funds actually build wealth. Subscribe for more realistic passive income breakdowns.